Swayam Prabha. Digital India. Educated India.
Hi all, welcome to this session on commodity derivatives and risk management. And if you recall, we were discussing about different aspect of this index creation, that is a freight index creation, and which gets reported by the Baltic Exchange. And if you recall, we discussed these different indices, and I was discussing about the Cape size index detail. And this, if you can recall this, we discussed that for a particular index you will have different routes which has been identified by the index committee, and besides the routes, the actual price quotation, that is the rate at which shippers and charterers are renting out ships in these in these routes, are collected from the ship brokers. And who are these ship brokers? Baltic Exchange Cape size index panelist. If you can see, this is the panelist which has already been identified by the Baltic Exchange as the panelist who are going to give their price information to the exchange for calculation of your Cape size index. Now let's take an example to see how this is calculated. It's a simple calculation, but let's spend couple of minutes. So if you can see, this is the Baltic Exchange Cape size index calculation. So which body calculates it? Freight indexes and futures committee. Every exchange has a committee which responsibility is to identify the routes, which routes will be part of the index, and what are the weights associated with this these routes. So this FIFC, that is Freight Index Futures Committee, also identifies the panelist from whom it will collect data. So that also I have already shown. And please note that these panelists are the brokers, ship brokers. These are not the actual charterers or the ship owners. So these panelists are the brokers who are aware of what is happening in the underlying market. They have more information than one particular charterer or one shipper. So a charterer who is interested in only maybe interested in sending or importing or exporting goods in a specific route, they may be having information with respect to that particular route. But a index is calculated not only for a specific route, index is calculated for all routes. Or index is calculated by taking price information pertaining to all routes. So that is the reason why Baltic Exchange does not take any price information from the charterer or the shippers. Now, how exactly the index calculation? It is a simple calculation. It is you have PI. So this is the freight rate for individual route. But for an individual route, let's say you have out of 10 panels, the exchange received quotation price information from 7 panels. So this PI will then be nothing but the average rate given by the panels for a given route. So it is simple average. If a particular route, out of 10 panelists, the exchange has received 7 price information. So that is going to be averaged out to identify the price associated with the particular route. And similarly, if you remember, for a Cape size, maybe around 15 routes are there. So there are, it's mentioned 4 routes are mentioned here. It will be around 10-12 routes are will be there. I have to just if you see this document, you will be able to identify how many routes are there. So each route has a weight. So what is going to be the index value? Index value is nothing but the summation of Pi into Wi, that is price of one route into weight of that route, and summation of that and divided by index base value. So this I0 is nothing but your index base value. So this is how exactly the Baltic Exchange calculates the index for all indices which we just discussed. Now the next question which you may be thinking, that how does the FIFC, that is your Freight Index Futures Committee, decides which routes to choose? So it's again is the same dilemma when some 5,000 companies are listed in a stock exchange, and the exchange committee identifies as only 50 companies to represent the index. It is the same mechanism through which the routes are identified. So the routes are identified with respect to geographical balance. That means the chosen route should not be concentrated on a specific in one geographical location. It should be as widely dispersed as possible. And second, another very important criteria is the liquidity. The chosen route should have a significant shipping activity. So when an index represents the broader underlying market, then the route should have enough shipping activity, otherwise that route should not be incorporated into the index. And finally is the standard preferred voyage terms. It becomes, if the route has a standard preferred voyage terms, so all participants, whenever they are quoting a price, so the exchange knows that price is with respect to a particular standard specification. Otherwise, if different ship brokers are offering different rates or giving different rates with respect to different shipping conditions, then probably that is not a proper way of calculation of the index. So all these 3 factors goes into consideration for calculating the index, and the index calculation methodology we have already discussed. Now let's go to this is again I downloaded the data from the Bloomberg database, and please see this one. This is a Baltic index. This is the top one is a Baltic dry index, and the red color this thing is a Baltic dry index. The blue one is a Baltic dirty tanker index, and the brown color line is your Baltic. Okay, there's a spelling mistake on my part. This will be Baltic clean tanker index. And if you can see, this Baltic dry index, which represents the global, trade in a significant way. So that picked up during 2008, and it significantly dropped down, and it is hovering at a almost below the index initiation value. Index started around 1000 in the year 1985, and it is quoting around let me take you to the data. Yes, if you can see this data shows you have on that is 30th May 2008. It is a monthly data. 30th May 2008, Baltic dry index picked. It went up to 11,440, and as on the last date, that is the 1st July 2007, 2016 it is hovering around 677, and all of you know, with the economic recession and economy going down, not much of activity is happening all over the world. And in fact, the Baltic exchange is considered to be a precursor to the economic activity. So a lot of people keep note of how the Baltic exchange is moving. If it is going up, then they know that next quarter or subsequent 2 quarters later, economy, the economic reports are going to be showing positive indication in terms of the GDP growth rate, etc. So it's a leading indicator, or these indices are leading indicator of the economic performance. Now, besides this, Baltic exchange, Shanghai exchange also calculates and reports a containerized freight index, and the methodology is same. It takes the spot rate of, or the rates identified, rates quoted by sea brokers for 15 designated routes, and these routes which are they cover sea routes between Shanghai Europe, Shanghai US East and West Coast, and Shanghai to Asia, and Shanghai to Africa, and Shanghai to Australia. Basically all trades which is export import is happening between China and other part of the world through container ships. This index represents that particular market. Now let's go to our understanding on how these forward indices are used for hedging freight rate risk. And what we are going to discuss is a OTC contract. Though futures and options are traded in the CME, but majority of hedging happens in the OTC market, that is the market which is associated with the Baltic exchange. Now let's take an example. What exactly is the freight forward agreement? So in case of a freight forward agreement, it's a hedging instrument in which charterers and shippers enter into a contract for a specified time charter and voyage rates for forward position. So let me repeat. It's a derivative contract. It's provides a mean of hedging the exposure to freight price risk through trading of specified time charter and voyage rates for forward position. So what exactly happens? That is, let's say both parties have some views with respect to whether charter these freight rates are going to go up or go down. Let's say a shipping company is fearing that this freight rates are going to go down, and it can enter into a forward contract for mitigating that risk, and it fixes the price at which it will be able to lease or rent its ships through the freight forward agreement. Similarly, let's say a charterer fear is that the price is going to go up if he does not do anything, and to mitigate that price risk associated with freight rate, it can enter into a forward contract in which it will pay a fixed rate for every voyage or every series of voyage it is interested to undertake. Now what will be the contract terms? It will be the route, the settlement date, the contract quality, who is going to be the fixed price payer, and who is going to be the fixed floating price payer. In fact, if you recall, it is nothing but a swap agreement. So it is basically some party will be selling the swap and some party will be buying the swap. So this is the this is predominantly this happens in the OTC market. Now let's take an example how this freight forward agreement works in real life. Now let's say you have a charter, you have a charterer, or let's say exporter of iron ore. And what is its fear? Its fear is freight rate is going to go up. And how it will be able to mitigate that risk? It enters into a freight forward agreement. It enters into a agreement, that is your FFA. So in that case, what the charterer will do, so the charterer will be, let me name it him as a X. So what is X fear? X fear is that he is going to pay a high rate or a floating rate when he actually hires or enters into a voyage charter or a contract of affreightment. He has to pay a higher rate, and how he can mitigate this particular risk, price risk, by entering into a freight forward contract? He will be agreeing to pay the fixed rate, and he will be receiving a floating rate. And who is the counterparty? Let's say counterparty is, we name the counterparty as CP, and X will pay fixed rate to the CP, and CP will pay a floating rate. And which is that floating rate? Floating rate is nothing but your underlying index, maybe let's say that is your Baltic dry index. So if Baltic dry index value has gone up, let's say, and this index value has gone up and the charterer fear has come true, he will be paying fixed rate to the counterparty, and he will be receiving a floating rate, which is the higher dry index value. And simultaneously, when he goes to a shipper for a time for a contract of affreightment or a voyage, he will be paying a higher rate. So this is an example of a freight forward agreement, and in this case, this is a swap contract, and X, by paying a fixed rate, X is buyer of FFA, and CP is seller of And let's go to we'll take another example where the shipper is fearing that the freight rate is going to go down, which is the case right now. In fact, the shipping rate also is very, very strongly related not only with the economic activity, it is also related with the crude oil price. So if crude oil price goes down, the bunker cost goes down, and the shipping rate also accordingly goes down. So the shipping company is fearing that price is going to go down. How he will be mitigating the risk? Let's say we were naming the shipping company as a SC. SC's fear is price. When I am using the word price, I am meaning it is a freight rate is going down. So how he will be mitigating this risk with respect to FFA? So what is a SC? SC's fear is it will be receiving less amount. That is, less freight rate goes down, so less freight rate will prevail, and it will receive less freight rate. So how he will be able to mitigate this risk? So it would be interested to. So let's say we have a counterparty here. So you will have SC will be paying the floating rate, and SC will receive fixed rate from the counterparty. So let me repeat. So SC's fear is that it is going to receive less amount of freight rate if it does not do anything. Now how this company will be able to mitigate this risk? It will enter into a freight forward agreement for some period of time into the future, maybe 6 months or 8 months depending upon the expectation. So it will be receiving receiving fixed rate from the counterparty, and it will be paying the floating rate. So if his fear is true, this company SC will pay less rate to the counterparty, and the counterparty will be paying a fixed rate to the Shipping Corporation of India. I'm sorry, the counterparty will be paying a fixed rate to the whoever is the shipping company. So this is an example where you have your SC, that is your shipping company, is the seller of the FFA, and the counterparty is the buyer of the. As you remember, you have a buyer is a party which pays the fixed. So in this case, CP is paying the fixed amount hence to the shipping company, hence CP is the buyer of the FFA and SC is the seller of the FFA. And all this buying and selling of FFA is done through OTC market, but this particular market is cleared at all these transactions are cleared at the exchange platform, that is your Baltic exchange platform. So buyers, FFA buyers and FFA sellers will be giving their bid and ask quotations. Order matching will happen. When order matching happens, the counterparties will take position, and payment and receipt with respect to these FFA contracts are executed through the Baltic exchange infrastructure. So with this, I would like to end up this session on the freight derivative. Also, I would like to add a couple of lines here, in the sense that these freight futures are also available for trading at CME, and underlyings are Baltic exchange, Baltic indices. So the forward contracts have the futures contract have the underlying for different indices, Baltic indices, which we discussed. And with this, let me summarize what we discussed with respect to the freight rate. We discussed what are the weight cargo, what is the difference between weight cargo and dry cargo, what are the different types of cargo ships, and depending upon the deadweight size, depending upon whether they are carrying a dry cargo or liquid cargo, and how your Baltic exchange calculates different indices, and based on these indices, how freight forward agreements are undertaken by the shippers as well as the charterers to mitigate the freight price risk. With this, I will be proceeding with the next part of our discussion, that is a spot market for our water. So this is also again another innovative trading which is happening in exchanges. So I'll just in very briefly I will discuss what is a spot market for water, and how water trading is happening in the through exchanges. please, all of you may be knowing that the water is going to be the next major scarce resource for all of us, considering the urbanization and the amount of per capita water consumption which is increasing day by day. We are, and all of us, we know that we are staring at a major water crisis. So now in certain exchanges water contracts have started trading. I'll just give a case study with respect to how water is being traded at Australia, some part of the Australian subcontinent. Please note that during 1994, Council of Australian Government made water as a tradable commodity by separating the ownership of the land with and the ownership of the water. So that means if somebody is owning a piece of land and there is a water body, there is a pond or there is a lake, then the water is not owned by the person. The water is owned by the government. It is the government ownership. It is not, water is not privately owned. So in that case, with respect to this, so Australian the government, Council of Australian Government created a corporation called Goulburn-Murray Water Corporation of Victoria. It became a statutory body which was created by the Australian government, and this GMW managed the water trading issues in the state of Victoria, covering around 68,000 square kilometers. So all farms and all animal firms which were rearing animals and firms who are into farming different agri-farm products, they require water, and water is a major scarce commodity over there. So what basically this Goulburn-Murray Water Corporation did is that it gave some X amount of water freely available to each and every company which is operating. Let's say in that within the 68,000 square kilometer, you have 5 companies operating, and depending upon these 5 companies' business, let's say this company had 5 companies are operating, A, B, C, D, E, and depending upon the availability of the water, let's say 1000 kiloliters of 600, 700 kiloliters, maybe 400 kiloliters, and 500 kiloliters were freely distributed to these 5 they had the right to consume. I should not say freely distribute. They have a right to consume this much of kiloliters of water depending upon their existing business size. So A has the maximum amount 1000 kiloliter available to him. Now A can, if A decides to utilize less water in its day-to-day operation for running the business, A can sell this water to the other 4 parties. So how A will be able to sell the water? A goes to the exchange platform and A does an auction, and based on the auction, whoever is the highest bidder, whoever is willing to pay more money, that party gets the right to use the amount of water which has been sold by A. Now how it will be executed? They like a electric grid system. All these water bodies are connected to a grid. So A will release whatever the amount of water it agreed to sell it to the counterparties. A will release that much of water to the grid, and the counterparty will extract that whatever amount of water it bought from A, that amount of water it will extract from the grid. Now what is the risk associated with it? suppose A has underestimated its water requirement and A has already sold it to the counterparty, and counterparty has already utilized that amount of money, that amount of water, then A will be facing water scarcity and its business operation may take an hit. Suppose if rainfall happens and A has sold it, and if rainfall happens and everybody got A's water requirement is not high enough, so A gains from this particular transaction, and if rainfall does not happen and A has already sold it, then A may face the risk. So how exactly this order matching happens, please see this one. This buyer and seller give their bid and order is matched by this gold bond water authority, and all buy and sell bids are collated and orders are matched, and accordingly buyers consume more water and sellers get more money through this particular transaction. Of course, there is no derivative contract, futures contract are not yet started to be traded, but I don't think there is much time left. Sooner or later we will have some exchange where the consumers, bulk consumers of water and maybe municipalities will be able to enter into forward contracts or future contract for delivering water and consuming water at a later point of time, and the price is decided at an early stage like any forward or futures contract. So with this I would like to end up my discussion, and again we will be continuing with the remaining part of the discussion in the subsequent classes. Thanking all of you.